Joining me now to talk more about that, Steve Whiting is Global Chief Investment Strategist at Citi Private Bank, and Dan Genter is CEO of RNC Genter Capital Management. It's great to have you both here. Steve, you're a little more constructive in general on the markets and on the economy. So, what do you say to investors who are concerned about how much worse the headlines could get, or if we start to have further restrictions on economic activity?
Well, look, I think this near-term period where we have not only COVID winter, but significant policy uncertainty about the United States, when you can't be certain who will be the president of the United States, what party will be in control, then you're going to have some elevated volatility. It's already there in the options market, where you can see twice the usual level of implied volatility, and actual equity markets only in the past month have sort of caught up with that. But that isn't the outlook for the whole year to come. And certainly when you think about the alternatives for issues that we will resolve, we will certainly resolve the election by the beginning of the year. We will, in every likelihood, with 6 COVID vaccines and late-stage clinical trials, have a very likely medical solution next year. It's going to be a very different economy. And then taking your money out of a good portfolio and putting it in incredibly rich bond markets or negative real yield cash doesn't seem like an ideal thing to do. I think it'll be very mistimed.
So, Dan, let me ask you this, because some of the names, the picks that you'd recommend are in the financials, in the energy space. In order for investors to feel comfortable on those, do they basically have to be making a bet that the pandemic in general is going to get better? I mean, can you own names in those sectors without being exposed to every little twist and turn of the macro?
Well, I think, Kelly, agreeing with what Steve said, we're just going to be in for a period, especially the next 30 days prior to the election, of just having extreme volatility. And we're still dealing with the COVID situation and the recovery and the vaccines and all the things that everyone's discussing. But I think when you look at these issues, I think there's 3 reasons to own them. Number one, frankly, right now, is it's a good place to hide out. These financial issues, the energy issues in particular, I mean, they've been beat up pretty bad. So when you look at where the PEs are, they're trading at very reasonable levels right now. Energy consumption is starting to recover. It's only down 10% from pre-COVID. And we're seeing the economic numbers slowly but surely begin to recover. So if they're in a basing pattern where they are now, and many of them are paying 4%, some even 6% while you wait, it's only taxed at 20%. And I think clearly we're looking, into 2021 of seeing earnings go up, not dramatically, but 5 or 6%. So if you can wait this out, average out 4.5%, it's a good place to really wait this out going into 2021.
So maybe put differently, you'd say there's enough of a margin of safety there because of the low valuations to even handle some bumps in the road that we might hit. Steve, I'll turn back to you then, because real estate is one of the places that you're recommending. Why?
Well, look, this is a very beaten down part of the economy. It's certainly a beaten down part of the markets. And certainly there will be some distressed areas. Will we go back to use office space at full occupancy as if nothing happened if there is a COVID vaccine? Probably not. Are we going to see shopping centers filled with lots of parents looking for a place to go with their children? Yes. Have we seen any reason why people who are going to use their home, using their apartment as their office, not pay their rent if they have a job? No. So I think that there are real distressed values, good dividends to be had. And in fact, if we take a look in credit markets, the commercial mortgage-backed securities market, for one, in investment grade territory has higher yields than the junk bond market. And so we always look for portfolios. We want to hold on to the things that have held and allowed the economy to adapt. That includes technology stocks. Many have got a bit too rich to really concentrate and have at the very high level at market weightings. But we have to start to add. When you think about the economy the year ahead, you do need to take advantage of these lower prices now. And that's why we have a modest overweight across the world in real estate assets.
It makes sense. I mean, it's an interesting point. Dan, I'll circle back to your specifics so our audience knows. You'd say Phillips 66, Sempra Energy, JP Morgan. Are there any others?
Well, I think in general, again, there's some bottom fishing that you can do, additional names, Bank of America, et cetera, all on the financials. And I think what you're seeing, Kelly, is that, loan creation is picking up. The government stimulus is bringing people back to work. People are getting reemployed. All the consumption numbers are going up. And I think, again, these are names that have more or less bottomed out, and I'd be looking to buy them on any weakness and to be able to capture that dividend, which is just going to be very, very efficient. I mean, the bond market is very, very rich right now. Obviously, you're getting zero in money market funds. And a lot of people, you can't just exit the market because you have huge embedded capital gains that you have a certainty you'll have to pay as a liability. So these are just all strong names where that flow, I think you're getting in at a good price point with a 3-year time horizon.
All right. Gentlemen, thank you both. Appreciate it. Some specifics, not a consensus ideas. Dan Genter and Steve Whiting.
Shepard Smith here. Thanks for watching CNBC on YouTube.